Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have a very special guest, Dr. Marc Faber. He is the editor and publisher of the Gloom, Boom, and Doom Report, and the website is www.gloomboomdoom.com. Welcome, Dr. Marc Faber.
Thank you.
Yeah.
Thank you for having me.
Great. And we're just wondering your thoughts on the 2017 outlook, where you see the financial markets and the global economy heading in terms of the stock market, commodity markets, and the bond market?
Yes, I think it's a good question because we don't know what will happen. To make forecasts is always very difficult, and everybody asks me, what do you think about this and that and so forth. But the reality is that we don't know much about the past. We don't even know much about the present because the media is misleading people. And we know nothing about the future simply because markets nowadays are not normal markets. These are markets that are manipulated. And they're manipulated by central banks, essentially who can print. And I repeat, they can print an unlimited amount of money. That central banks are out of bullet is simply nonsense. They can keep on printing. They can buy all the outstanding bonds. They can buy all the outstanding equities. Then you essentially socialize everything. You nationalize the entire economy if the central banks buy all assets. They can then proceed to buy all the real estate, and they can print the money and hand it to people, and the money then becomes more or less worthless. So we have to live with that fact. It's a great uncertainty. But in my view, it is probably dangerous to be 100% in cash. Don't misunderstand me. I'm bearish about the world. I'm bearish about the outlook for the global economy. But equally, I think it's very dangerous to be 100% in cash, because if you were 100% in cash in 1980, 1990, year 2000, even year 2000 when the stock market peaked out, you lost an enormous amount of purchasing power when you compare it to how much stocks went up between August 82. The Dow at the time was 780. We're now over 20,000. Commodities were depressed, relatively speaking. Bonds were terribly depressed because short-term interest rates were close to 20%, and 10 years U.S. Treasury was yielding over 15%. So between the early 80s and today, and you asked briefly before about inflation, we didn't have an enormous amount of consumer price inflation, but we had a colossal amount of asset price inflation. Real estate, stocks, bonds, collectibles, and so forth, art. These assets have all performed magnificently with some interruptions. There were corrections and so forth. But in general, if you were all in cash, you missed out on these market moves.
And do you see that type of inflation from asset inflation morphing into an overall consumer price inflation?
Well, that is the big question that nobody knows exactly. But my suspicion is that, first of all, we will have to, my definition of inflation is basically an increase in the quantity of money and credit. And then you have symptoms of that increase in the quantity of money and credit, and these symptoms are either wage increases like we had in the 60s, or commodity price increases like in the 70s, or you can have stock price increases like between 1982 and today, or you can have an increase in bond prices such as we had between 81 and the summer of 2016 when the 10 years touched 1.34%. But I believe the central banks can continue to print money, but to keep all asset prices up is like someone who is juggling balls in the air. He can keep on adding balls until there are too many in the air, and one day the one or the other will drop, you understand? So if you look at the last few years, not all asset prices have gone up. Say emerging markets went down. I think emerging markets are now relatively cheap. Or despite the money printing after 2011 around the world, precious metals went down. They didn't go up, which was surprising for most people, but it just happened. So to boost everything will be difficult, because when prices go up, of course the supply also goes up, and then the increased supplies, whether it's commodities or the increased supply in securities, then essentially lead to lower prices. So my view would be 1960 to 1980, we had rising consumer price inflation, rising interest rates, and stocks that after 1964 didn't go up. In real terms, they went down actually 80% because the dollar was weak after 1971. Now we had this asset inflation, and I suppose the next 10 years will be a period of rather asset deflation than inflation. I think if you look at stocks, they're expensive everywhere, but they're particularly expensive in the US. Now, there are some emerging markets that are cheap, and there are some stocks. You know, you look at, say, 1,500 stocks, some are not terribly expensive.
Do you think that the governments and central banks of the world are interested in generating a certain level of consumer price inflation in order to ease the burden of government debt over a long period of time, given a certain amount of inflation? Do you think that is the case?
Yes. If you have deflation, the burden of an over-leveraged system is very high. And when you think about it, who benefits the most from inflation and who is hurt the most from deflation? Governments, they have these huge outstanding debts in some countries. The government debt, like in Japan, is maybe 220% of GDP. In the US, it's roughly 100%. In Italy, 170%, and so forth. So these countries, for them, deflation is a catastrophe because they have to keep on paying the interest. They are desperate to create inflation. But in general, I would say, yes, governments are interested in inflation, and they will try, say the US inflation rate officially is not very high. But I can tell you that all your listeners, they have had rent increases. They had food price increases. Their cost of insurance and insuring themselves went up a lot. Why is consumption relatively weak? Because most young people don't have any money after paying the rent, the insurance premiums, and the taxes that have also gone up, despite all the rhetoric that taxes are going down and being slashed. They slash them here and increase them somewhere else.
Yeah. And what about fiscal policy now that like governments, for example, in the U.S., Trump has announced infrastructure spending. In Canada, there's a new a bank for infrastructure that has been created, and there's been discussion elsewhere. Do you see that as coming up and replacing monetary policy stimulus, or working in conjunction with monetary policy stimulus?
Yes, I think this is going to happen, what you just said. Fiscal policies that are expansionary will necessitate expansionary monetary policies, otherwise interest rates go up substantially. So I think that the fiscal policies that are expansionary are not necessarily favorable, because as a result of them, interest rates could go up. Now, the Fed may choose, say, to print money, which they're likely to do, especially if the Dow Jones were to drop, say, 10, 20%. The low in February 2016 on the S&P was 1,810. We're now close to 2,300. I guarantee you we have QE4 if the S&P drops again towards 1,810. But aside from that, when interest rates will tend to go up, and we've seen that yesterday already, the Fed will be very reluctant to increase rates significantly. They will lag behind. In other words, inflation could be one day 5% per annum, or the cost of living increases. That is probably a truer measure of consumer price inflation than what they published in terms of PCE index and CPI index. But say, if the inflation rate and the cost of living start to move up, the Fed will increase rates. But in real terms, rates, in my opinion, will stay negative. Inflation-adjusted rates, you understand? So the cash holder will lose out regardless.
Yes, you mean in terms of the real inflation.
Purchasing power.
Yeah, purchasing power and negative real interest rates after you
Correct.
take inflation into account from nominal interest rates. Yes. And
we know that because if you look at the recent economic literature of the establishment economists, they essentially advocate the abolition of cash because they argue, well, it will eliminate crime, which is complete nonsense. The big crime in the world is not committed by people who carry banknotes in a suitcase. The big corruption is in governments and in contracts where money moves elsewhere. But the other argument for abolishing cash is basically to say, well, we get rid of cash, and then the central bank, if there are deflationary threats, could push interest rates to say -3% per annum, -5%. So you deposit $100,000 with the bank, and after a year you only get 95,000 back. This is now a subtle way of expropriation of goods.
Yes, and it's happening quite.
And this is what, but this is the mindset. You have to be aware of that.
Yes.
This is the mindset of central banks. Essentially screw the ordinary people that have savings in order to save the financial market and the over-indebted governments that actually retard economic growth because they have outgrown their usefulness.
On that note, how do you see what is happening in India in terms of what they've done recently, eliminating 86% of physical cash? How do you see that happening, or how do you see that evolving, the outcome in India?
Well, they declared certain banknotes to be invalid, and you had to turn them in. And when you turned them in, there was a minimum limit of, say, $1,000. Nobody asked any questions. So you could turn the $1,000, the rupee equivalent, into new banknotes. It's not that there is no more cash in India. There's new banknotes. And, of course, the elite and the rich people, they had advance notice to start with. So they got rid of the cash before.
Yeah.
And number two, say you're rich and you're corrupt and you have $100,000 in cash and you cannot document where the cash came from because you never paid any tax. These are the people the government wanted to go after. So what do? You hire 100 people that are impoverished. You give them each $1,000. People go each with $1,000 to the bank and turn it into new banknotes.
I see.
And then you give them a commission of 5% or 10% or whatever it is.
Okay.
But basically, the fact that 86% of the money was turned in shows that there was very little illegal money in the system. In Italy, there's probably much more illegal money in the system.
Mm.
And in India, if there is illegal money, believe me, it's not among the poor farmers that have an annual per capita income of, say, $600-700 maximum. It's in the hands of big government officials and bankers and rich businessmen.
I see.
And these people, they have a way to do these, to evade all these rules.
Hmm. Do you see this trend as expanding?
It's a complete joke, this Indian experiment. But I'd like to emphasize here, nobody in India had that idea. The idea was fed to the Indian government by some think tank in the US or some economists in the US, you understand?
Yes.
It's not that suddenly Modi, the Prime Minister of India, woke up and said, we're going to do that.
Okay. Yeah.
Someone fed it to him.
Yeah. Do you see that as being a trend, like this sort of development of what's happening in India spreading to beginning in other countries?
Well, I mean, you know, the governments always have a way to try to maintain their power and to increase their power. And they kind of, through the media and through crony economies that are essentially on the payroll of governments, they can tell the public, you know, one of the problems of criminality is cash. I think there is some criminality related, and some criminality happens with cash and illegal activity. But if you ban cash, it will continue or even increase. There'll be so much cybercrime. You want to know where to start.
Wow.
So this is a pretext. You understand, the criminality. The real reason is they want to give more power to central banks, basically.
Yeah.
Now, under Trump, maybe some power of the central bank will be removed. But that is just until the next recession happens or the next stock market decline or stock market crash. And as I said, I bet you if the stock market declines 20%, say towards 1800 on the S&P, for sure we'll have another QE. Whether they will call it QE4 or they'll call it helicopter money or whatever it is, but it will be essentially the same, money printing.
And speaking of Trump, you recently made some observations on the potential for the stock market in the U.S. to go lower, to go down, given loss of confidence resulting from the policies of Trump in terms of protectionism, trade, immigration. Can you elaborate on that?
Well, frequently Trump has been compared to Ronald Reagan when he became president of the U.S. He was elected in November 1980 and became president in January 81. And under him, asset prices went up and the economy performed not superbly, but reasonably well. The difference between essentially Trump's election and Reagan is that Reagan, when he became president, as I explained before, at the time asset prices were very depressed. In other words, the bond market was yielding more than 15%. And in August 1982, the Dow Jones was at 780. So stocks were very depressed. When Reagan became president, the index was around 1,000 on the Dow, and it then went down 20%. And it was no higher than it had been in 1964. Trump, he has a huge headwind. I mean, I'm not saying that interest rates will necessarily go up strongly, but in my view, they won't go down very much. Number two, stocks at the time Reagan became president were yielding around 6-7% dividend yield. And the PEs were also around 7 times earnings. So stocks were very depressed. Number three, and that is an important point, the US dollar at that time had collapsed between 1971 and 1979. It bottomed out in the 79-80 period. And so he had huge tailwinds when he became president. Trump, he has basically an overvalued dollar. He even realizes that, which is an achievement for him.
Yeah.
And he inherits a stock market that is very high. He doesn't want the stock market to collapse. When the stock market crossed 20,000, he tweeted very happily and took kind of credit for this landmark.
Yeah.
But, and then also the bonds. You know, the bond yield has gone up a little bit there today on the 10 years, something like 2.4%. But by historical standards, this is a very, very low yield. And this high valuation of equities and low bond yields,
yes,
they bring about, and not just in the US, in Europe even worse, they bring about a problem of pension fund liabilities. The pension fund system at these kind of valuations and these interest rates is basically bankrupt. They have to cut the pensions they give to pensioners, or they have to increase the contributions meaningfully, which is like an additional tax, and so forth. So with low interest rates, the Fed has actually created numerous problems.
Yeah. It's quite interesting.
And look, go to any place and ask people, what do you think about the stock market? Most people are not wildly bullish, but they think asset prices will go up. And then you talk to the real estate guys, they all think that real estate will go up, when in fact a lot of real estate has recovered from 2010, the lows, but has started to go down in the last 6 to 9 months in San Francisco, in New York, in the Hamptons, and so forth. So all these factors will be a headwind for the economic policies of Trump. Don't forget, the financial market today, globally, not just in the US, is disproportionately large compared to the real economy, the manufacturing sector, for instance.
Yeah.
That was very different in 1980.
Yeah, and then there's the factor of China with significant amount of debt, 15 to 20%
Sure.
of GDP.
Yes, absolutely.
Yeah, in terms of non-performing loans. What's
Sure.
happening in China? You're calling. We're talking. I think you're in Chiang Mai, Thailand, very near China. What do you see happening in China?
Well, to tell you the truth, nobody knows for sure. I know some respected economists that follow, say, the Asian region very closely, and they were bearish about China, and now suddenly they're more optimistic about China. They think they can avoid a recession. My sense is that the economy has definitely slowed down. There's no question about this. And the economy will continue to slow down to, in the long run, in my opinion, a growth rate of, say, around 4% per annum. Now, 4%, when you think of it, is magnificent compared to Western Europe and the US and Japan.
Yeah.
So even if it slows down, it's not the end of the world. Number two, I'm a little bit more cautious about China than some of my colleagues who aren't these economists, because I think they have a gigantic credit bubble. And that will hurt consumption at some point, because the consumer invested in a lot of things, whether it's real estate at overpriced levels or in wealth products that are fraudulent frequently. He's going to lose money. Then his consumption will go down. But you look at the US, 1800 to today, how many recessions they had. Already in the 19th century, they had 18 recessions and 18 financial crises and the Civil War. And then in the 20th century, they had World War I. They had a recession that was very severe in 1920-21 following the First World War. Then they had the Depression, and then they had World War II, and the Korean War, the Vietnam War, and so forth, and the country continued to grow. So for me, the best for China would be to have actually a serious recession, because that would clean the system. It's like a human body. A human body takes a rest at night, usually. Some people also sleep the whole day. Most people who work for governments, they sleep night and day.
Okay.
But aside from that, you need a resting period and you have a period of activity.
Yes.
And you are sometimes sick. Sicknesses are useful. It's wrong to get rid of every sickness with pharmaceutical products.
Yes.
If you have a headache, there's a cause for that. Then you shouldn't cure that headache or cure the symptom only with drugs.
Yeah.
You should address the question, why do I have a headache? Maybe I didn't drink enough last night.
Okay, yeah. Okay.
Or I looked at Hillary Clinton. That's why I have a headache.
Okay.
And so forth. So, recessions are useful in the sense that they clean the system. It's like a forest.
Yes.
A forest has from time to time a fire. If you suppress that fire all the time, eventually it's much worse.
Yes.
And the recession cleans the system. It cleans the bad debts. And most importantly, and this I have to stress, if you have a capitalistic system and a market economy, let's say you and I each has a business. I invest in my business and I save money, and with that money I repay my debts, which I may have used to buy machinery. I buy new machinery, and I have in the end no leverage. But you're a funny character. You have your company and you inherited it maybe, or you were fortunate to raise money through the stock market, and you just go and waste that money that you earn on expensive holidays, on mistresses, on political contributions, and so forth and so on.
Yeah.
But you never buy new machinery. You never reinvest the capital in the business.
Yeah.
And over time, you even build up debts because you don't invest, you become less competitive, so you borrow money. The end, you have debts, I have no debts, and I have new machinery, and you have debts and no new machinery. And then the recession comes. Well, the recession should basically wipe you out because you misbehaved as an entrepreneur.
Yes.
I'm not saying you personally.
Right. Yeah. I understand. Yeah.
You have to understand.
Yeah.
And that eliminates the competition. And because the competition then gets washed away, the price level stabilizes. But if the government comes in and keeps these clowns that manage their business as I just described, such as banks, by the way,
yes.
then the price level is rather likely to fall. In other words, these interventions by central banks and interventions with fiscal policies may actually aggravate the deflationary pressures and not remove them. And you understand? So the economic system lives essentially in a free market, and that's the beauty of it, that young companies start, and the old companies that look backwards in the mirror and not forward, they don't innovate, that they are wiped out. And that's why we have progress in the world. If we don't have that, forget it, then we're going back to a socialist system.
Yeah, that's very good insight. And so if that were to happen to China, would there be negative effects on other parts of Asia in terms of, for example, investments and currencies of Southeast Asia?
There's no question that a slump in China, and I'm not saying it will happen, but it's likely to happen at some point, that this will have a huge impact on the world. Huge. Because the US, don't forget, is a slightly larger economy than China. But the US is over 70% consumption. And of that consumption, it is 70% services. Services hardly need any resources. China is still a manufacturing center, and there are huge capital spending in China. Say the US plan under Trump is to spend $1 trillion over 10 years. It's a joke. By October 2016, China had already spent more than $1 trillion in 1 year. You understand?
Yeah.
These are different dimensions. And if China really has a recession, the demand for raw materials will plunge. China exports much more and imports much more from emerging economies than the exports or imports from the US. The largest trading partner today in Asia and in Brazil, by the way, and in Australia is not the US, but China. This is a different world from the 50s. People like McCain, they still live in the last century where the US was, dominant. In the 50s, America was a dominant economy relative to the rest of the world. That is no longer the case. And this is not the value judgment. Maybe the world is better off with having a US hegemony than a Chinese hegemony. That I don't know. But these are facts, economic facts. China is the largest trading partner of 124 different countries. the US is the largest trading partner of just 74 different countries.
Wow. Given all that, how can investors protect themselves in a general sense?
Well, in my view, the only protection really is to be diversified, because we don't know what will happen. So I would suggest that an investor should own some real estate. I prefer to own real estate not leveraged. I don't like debts. I want to sleep at night.
Okay.
And during the day, as I just said.
Okay.
And I would invest some money in equities. As of today, not necessarily in the US, but as I said, there are some pockets of depressed equities. A year ago, or over the last 12 months, Brazilian equities in dollar terms, in other words, adjusted for the exchange rate, they went up 66%. The Russian stock market was up 55%. Kazakhstan over 60%. Thailand over 22%, and similar increases in Vietnam, in the Philippines, Indonesia. So there's always pockets of value somewhere. What the fund managers, of course, will never tell you is that it's not that energy was the best performer last year. It did well, but the best performing sector last year were mining stocks, gold, silver shares.
Yeah.
And many of them went up 300%. But the fund managers and the big institutions, they don't want to tell you because they all hate gold.
Yeah.
Each time you talk about gold, it's basically an embarrassment for the financial service industry, for the fund managers, whose gold was at $255 in 99, still at $1,200. Who of these clowns in the fund management industry has quadrupled or quintupled his money?
Exactly, yeah.
This is the reality.
Well, yeah, I agree 100%. And that has been great, fantastic insight, Mark, and we appreciate very much your thoughts.
Thank you.
Thank you very much for being on our program show. Hope to have you again shortly. Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only, and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.